Indicators break when markets evolve.
It evolved!
But not this one. As the markets adapts, your indicators should do the same. After years of research and with the recent breakthroughs in AI, we've finally developed an indicator that sits on the bleeding edge of market adaptability and predictive analytics. This indicator continuously adapts to changes, rigorously tests, and optimizes itself to operate at peak performance. We're going to break down exactly how it works, how to use it, and how you can secure it for free today. So strap in and let's get started. We all know the Supertrend indicator. You do. Your friends, even your grandma uses it. Well, this indicator is built on the back of the Supertrend. But what makes our version unique is rather than relying on a single calculation, it takes multiple supertrends, tests and groups them into clusters using a machine learning technique called K-means clustering. It then returns the best performing settings. By taking this approach, we can filter out weak signals and provide more accurate trend detection. To show how this works, we'll break down this indicator piece by piece to understand its key features. This is your naked chart, and this is your chart with the indicator. The labels indicate where the start of a bullish or bearish trend is detected, and if you focus on those labels, you'll see numbers. These numbers represent how reliable the signal is, with a reading of 0 being the least reliable. You can think of it as 0 to 3 indicating weak confidence, 4 to 6 being moderate, while 7 and higher indicate a very high probability of accuracy. You'll also notice that when these labels appear, a line appears alongside this signal. This line acts as a dynamic stop-loss level, always trailing behind the price in the direction of the signal, and can be used as a stop-loss when we first enter our positions. However, you'll notice a second line. This is called the trailing AMA line, or adaptive moving average. It works similarly to the regular trailing stop, but instead of strictly following trend signals, it adapts based on performance feedback. You'll see instances where a signal is detected, but the adaptive moving average trailing stop has not yet shifted. If this happens, you could consider it as your long-term trend, and it could act as a caution level as price approaches, allowing you to exit your position or wait for a break before taking a trade. Next, let's take a closer look at our candle colors. You'll see we used a gradient system to visually reflect trend strength. By doing this, we can gauge market momentum, seeing how the market shifts from a strong trend to a weak trend. This allows us to get into positions even if we miss the initial signal confirmation. The final major component we see on the chart is this dashboard. The dashboard provides information on the underlying testing of the supertrends. The cluster tab outlines the performance of different clusters, showing the best, average, and worst performing data for each row. The size column indicates the number of supertrends contributing to the cluster. The larger the cluster, the more reliable the data. Centroid dispersion measures how far the cluster values deviate from their average, providing insight into market volatility. Low dispersion suggests tight clustering and more reliable signals. The factor column shows the average supertrend factors used within each cluster. Higher factors indicate wider stop levels, which are less sensitive to price fluctuations, while lower factors indicate tighter stops, which follow price more closely, but may trigger more frequently in volatile or noisy markets. Now that you understand the features of the indicator, let's quickly break down some of the most important settings available. The ATR length acts as the foundation for all supertrend calculations, determining how responsive the indicator is to price movements. A shorter length sharpens sensitivity, allowing faster reactions to price changes, while a longer length smooths signals, filtering out market noise and reducing false triggers. Building on this, the factor range and step size define how the trailing stop behaves. The factor value influences the distance of the stop from the price, directly impacting risk tolerance. By setting a range of values, the indicator tests various configurations, which are reflected in the dashboard clusters. The step size fine-tunes this process. Smaller steps such as 0.5 introduce more granularity, allowing for finer adjustments and enhancing precision. This interplay between factor range and step size ensures flexibility in adapting to different market conditions. Performance memory bridges the gap between short-term and long-term market analysis. It controls the weight given to recent versus historical data. Higher performance memory prioritizes current market trends, resulting in quicker adjustments, while lower values stabilize the indicator by favoring long-term patterns, smoothing volatility. The cluster dropdown ties everything together by offering a choice between the best, average, or worst performing clusters. This provides adaptability for different trading strategies. Opting for the worst performing cluster might seem counterintuitive but can align with more conservative approaches, filtering out overly aggressive signals. Finally, The maximum iteration steps and historical bar calculation settings refine how deeply the indicator analyzes market data. More iterations allow for greater precision in cluster optimization, enhancing signal accuracy. Simultaneously, increasing the number of historical bars broadens the dataset, providing a richer analysis at the cost of speed. Balancing these settings allows traders to tailor the indicator's performance to their specific needs. Now that we fully understand how this indicator works, it's time to break down how you can use it in your analysis to get the most out of it. Just because the indicator can provide higher-rated signals doesn't mean we should blindly follow it. The best use of indicators lies in combining them with your own analysis, uncovering patterns in price data that might otherwise go unnoticed. Let's demonstrate this. On this chart, as price action unfolds, you'll notice several lower-rated signals appearing. This can suggest a ranging market. In such cases, it might be wise to wait for a higher-rated signal, like this one here. However, even a higher rating doesn't guarantee success. For example, this higher-rated signal would have resulted in a losing trade, but immediately after, another signal rated 7 appeared. As we've learned, we don't want to take signals blindly. Instead, we can wait for the price to start breaking above this consolidation zone before taking an entry with the trailing stop protecting our position. Following that, we see another low-rated signal, and shortly after, another high-rated signal appeared, leading to a strong rally. Out of the 8 signals shown, 6 would have resulted in losses, while only 2 were profitable. Interestingly, one of those 6 losing trades had a high rating. This demonstrates how we can approach using signals differently depending on whether a market is ranging or trending. And it also highlights how consistently combining higher-rated signals with solid analysis can increase the chances of success. It's also important to remember that the same principle applies to low-rated signals. While strong-rated signals provide confidence to enter at the start of a trend, low-rated signals call for greater caution. For example, in this case, we see a low-rated signal, so entering at this point would be a bad idea. However, as the price begins to move, we can see that a trend is clearly being established and we can start looking for an entry. So we can wait for a pullback, and by using candle coloring as confirmation, we can take an entry when the price breaks a significant low. At that point, the trailing stop can be used for stop-loss placement, allowing us to aim for a 1-2 risk-to-reward ratio or more. This indicator is incredibly powerful and represents a true breakthrough in traditional trading indicator. To access it, visit LuxAlgo.com/library and search for Supertrend AI Clustering to download it for free. Feel free to share your thoughts or questions in the comments, and thank you for watching.